Good morning and welcome to today's webinar, Real-Time Daily Trading Ideas. Today is March the 11th and I'm moderating our international webinar from our office in Berlin. My name is Alex Raftopoulos and I'm happy to be talking to you. Today we will be speaking about trading ideas, strategies, market screenings, and we'll be answering your questions. Before we can start with the actual webinar, we will briefly present the risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk, which is not suitable for all investors due to its complex nature. Please make yourself familiar with these instruments by using a demo account if you are a starter. Please feel free to contact us if you need any assistance with that. Please also note that none of this is investment advice. The statements made in this webinar only represent the personal opinion of our traders. You can also find the whole risk disclaimer on our website. You can see the schedule for the week. Today it's Jay's turn. And before I finish off with the introduction, I would like to invite everyone interested in trading to try us out and benefit from the best index and Forex offerings with spreads of just 0.6 pips. Please feel free to have a look around our website and explore our international activities. And do not hesitate to contact us should you have any questions. Enough of me for the moment, now it's Jay's turn. Good morning, Jay. How are you doing? What's your outlook of the markets for the moment?
Good morning, Alex. Good morning, traders. I hope you all had a very good weekend. Let me just double check. Can you hear me okay? Is everything fine in terms of sound, Alex?
Everything works perfectly fine.
Okay, perfect. Then let me just get the picture up and running. And this guy I'm going to turn off. Just bear with me 1 second, please. Okay, risk disclaimer is showing, and I should be showing screen number 4. And let me just see what you guys are seeing. Okay, perfect. So risk disclaimer is up. Now let me see. Great. I hope you had a very good last week. We had a tremendous amount of opportunity last week, especially with the mixed picture on Friday. So I wanted to dig into, we always start with the trade from last week. And last week, on Monday, I was very eager to long the US dollar versus the Canadian dollar. And at this time, the problem with the Canadian dollar was that the GDP data came in much worse than expected. You may recall that the economy in Canada was doing well, but the central bank did have an eye on the housing market. With GDP coming in so weak, all of a sudden we saw a tremendous weakness in the Canadian dollar because the assumption by the market for the Bank of Canada to be in a rate hike, on a path of rate hikes, was actually starting to get priced out a little bit. So tremendous weakness. This is this big bar that you can see right here. We were eager to long that on a retracement. Now, sometimes what happens is that the market, the fundamental drivers are so strong that you don't get that retracement. We didn't even get a retracement to what we call, let me show you this here by getting the laser pointer out. This would be what we call a role reversal here. And I was conservative. I kind of wanted to have that retracement to what we call the big figure, 132 evens in that area. But I already alluded to it. We never got that opportunity. This is actually what happened. So what did happen? The fundamental drivers were so strong. Where I start my line is where we actually had last Monday's meeting. So we kind of like accepted the liquidity above this recent swing high and used it to buy the market up. And as you can see, this is a 45-degree angle, which is a sustainable trend. Very difficult to get into a trend like that in a funny and exaggerated manner. I often say you just simply got to close your eyes and hit the buy button, which is of course nonsense. Basically, it means I missed the trade. Now, does that end my life? Is that difficult? No, it's not. It's just part of this business that I need to buy something below value. Value is the current market price, but also where you can see, for example, these POCs, point of controls. That's where most of the bid offer business is getting done. 70% of the time a market is range bound. Basically, that means that 70% of the time the market is doing what it is supposed to be doing, and that is transacting at fair value, where neither the seller nor the buyer have an economic unfair advantage. And that is the business of the market, is to trying to always determine and test for what is the fair price of any given product, because what we're looking at is not really a price chart. What we're looking at is an advertisement. Price is only an advertisement. High prices are there to attract sellers, low prices are there to attract buyers. It's just advertisement. You guys cannot get hung up on price. Price means very, very little. It means something very, very real and substantiating for your P&L. But for the big boys, it's all about volume. It's never really about price. It's about volume, getting trades on and off into the market and out of the market due to the sheer size. So no trade for us on the long US dollar, Canadian dollar. What do we have on our radar currently? Well, we had a very strong dollar into last week. Last week, Thursday, we had the highest print in the dollar index. Recall this is a basket of the US dollar versus 6 Western currencies of industrialized nations. 57% of that basket is made up of the euro. So if you put on a chart with the euro dollar and the dollar index, you will see a perfect negative correlation, almost perfect. So we had a very strong dollar last Thursday. We printed at a 3-month high, so we're very close to that. On global growth concern, we call that the dollar smile. The rest of the world stinks. Money goes into the US dollar because relatively to the rest of the world, the US economy is doing just fine. Euro weakness on the back of the ultra dovish ECB. Growth and inflation outlooks were revised lower. I was going to put together an entire slide of this, but then in the end, I got to be a little bit careful of my time. I'm doing this almost for free here, so I can't be spending too much time on it. So the ECB was trying to get ahead of the curve. Ahead of the curve. Usually central banks are behind the curve, roughly 4 months, plus minus. The ECB was trying to preempt what's happening anyways, and that is that we have slower economic growth in the Eurozone, and we have decreasing inflation expectations and a drop in actual inflation. And that is the worst that you could possibly have. And that is why they were trying to get ahead of the curve, and the euro simply tanked. Now, Morgan Stanley this morning put out a very aggressive buy alert on the euro US dollar for their institutional clients. I, at this point in time, do not share their excitement about the long US dollar, but it is a bit of information that I wanted to share with you guys. The US economic numbers, we had a pretty strong labor market. Now you exclaim, what, Jay, what are you talking about? We had a horrible non-farm headline miss. Yes, that is simply the headline number that was also distorted by the government shutdown. So while it came in at only plus 20,000 jobs versus an expected 180,000 jobs, dig into the number a little bit deeper and you see this component, which we call average hourly earnings, that came in higher than expected. This is called the Phillips curve, where a economy running at full employment, which we currently have, as you can see here, the unemployment rate in the US ticked lower, down to 3.8%, expected was 3.9. So we're inside of 4%, i.e. full employment. And that means in order to get skilled labor, you would have to pay more. Now, the problem is if economic growth is slowing down, which it is in the US, and no, we don't have any recession nearby or in sight, so don't get panicked about that. And yes, we are in a bear market in equities. While we don't have a recession on the horizon just yet, we do have a slowing of economic growth and an uptick in costs, average hourly earnings. So is that positive or negative for US companies? It's negative. Then the largest US companies generate their revenues in Europe and in Asia. Is growth slowing there? Yes. Is there stress on the horizon? Yes. So hence, equities in a bear market, dollar strength, because the rest of the world sucks in terms of economic growth. Very simple. On the Aussie dollar, we see that rate cuts expectations are getting priced out. Out, not in. Sorry, the slide is completely wrong. It's so wrong that I need to step in right now. Rate cuts getting priced out. Had to do it right now. That's how important that is. I cannot have that on the internet stating the wrong word. It's getting priced out. In addition, we don't have any resolution to the US-China trade war. The meeting between the president of China and the president of the United States has been actually canceled in the diary of the president of China. So, president of China is the head of the Communist Party. No resolution here. So what we're seeing in the futures market for the Australian dollar is that by September of this year, the futures market is pricing in a full 25 basis point rate cut. And in addition to that, afterwards, an additional more than 50% probability of another 25 basis point rate cut. We have the largest banks in Australia proclaiming the same thing, that they're stating towards the end of this year, they see 2 rate cuts, each in the amount of 25 basis points. So that causes Aussie dollar weakness. China is slowing. We had weaker export and import data last week, and Asia is slowing. Look at the South Korean GDP. Look at the South Korean import and export numbers. Look at the South Korean equity index. Look at the Philippines index. Look at Thailand. It's all slowing. The economic numbers out of China are produced by the Communist Party. They are fake. So we gauge economic growth in that region also by having a closer look at other Asian economies, especially South Korea. Pound, Brexit, drama to continue. I can't hear it anymore. Seriously, this morning I turned off the squawk. That's how aggressive I'm getting internally about it. It's bothering me to no end. It's horrible. So what we're seeing is tremendous pound weakness, pound going up, pound going down. Actually, the econ numbers weren't really that bad for the UK yet. And for this week, we expect stronger economic numbers as well. But the rate hike expectations of the Bank of England, which they alluded to during the last rate meeting, the governor spoke to us and said to the market and basically said, without that Brexit bullshit, we would be doing much better and we would be thinking about a rate hike. Now, the pound is not trading according to econ numbers right now, but it is trading on a minute-by-minute basis based on tweets, headlines, even what journalists are saying. I don't know. I'm staying away from the pound right now. What is interesting is hard facts. So a hard fact is that a lot of the shorts that were put in place by the big boys have been squared somewhat in the background. So reducing the shorts means that if we do get an extension, which is currently the expectation by the market, that the March deadline of the 29th of this month is not going to be adhered to, we have a meaningful full vote by May for her stupid ass plan again on Tuesday, which is expected to fail by more than 100 votes. Then on Wednesday, we have the next vote, which basically talks about extending the Brexit and taking the hard no-deal Brexit off the table. You can hear it in my voice. I'm just so tired of the shit. What's happening in Europe is that in Europe, we seem to be voting until the technocrats in Brussels get their desired outcome. Nobody gives a shit about the people. It's all about what these guys want. And so you just vote and vote and vote. And in the end, you do whatever the heck you as a technocrat in Brussels want anyways. So I'm just trade the pound at your own risk. If you know what the hell you're doing, happy days. Wish you good luck, make a lot of pips. I don't at the moment. And I just simply don't because I don't have a positive mental state towards the entire Brexit scenario. They have successfully wound down my patience. I'm an impatient trader to begin with, which is difficult in this profession. This is just, they've killed my patience. I don't care what happens, probably nothing. Probably it's just going to get extended again and again and again and again, and one day they come out to nothing. Goldman and Deutsche came out over the weekend with their research, and they stated that currently they only price in 10 to 15% probability of a hard Brexit, no deal Brexit scenario. Yeah. And the big boys in the background have reduced their shorts. So trade it at your own risk. Be careful. Violent moves, great for scalping. Absolutely. No question about it. Absolutely great for scalping. Canadian dollar, very important to have that on the radar because we had very strong employment data on last Friday, which were encouraging, but we do need to watch oil. Now this morning over the headline, Saudi Arabia said that they're going to extend, potentially even deepen their output, which is to balance the shale production coming out of the US. Recall that last week the US hit daily production capacity of at 12 million barrels per day, and tendency to rise further. So the Saudis have to cut to balance this. The rig count came off a little bit. Overall, the oil market has an interesting scenario where the Brent market is actually in backwardation. So we have near-term contracts trading higher than further out contracts, which in and of itself is not normal, because once the oil comes out of the ground and needs to be stored, that costs money, i.e. longer term contracts have to be more expensive. If you have the scenario that the front month contract is more expensive, something is off. So we are what we call in a demand environment. Now oil is being paid for in US dollars, line number 1 up here at a 3-month high. So somebody is in dire need of Brent crude. Otherwise, on an expensive dollar, the front month wouldn't be trading this high. The WTI contract, that's the US oil, basically is trading in contango, which is normal. That means the front month contract is cheaper than the back month contract. Okay, a little bit of futures 101 for you on top of it. Scenario overnight, well, it's not quite overnight. It's part of the London session already. I forgot to take a screenshot this morning, so this is pretty recent. We did see some Japanese weakness earlier on, and that continued until now. Now, recall that this month, due to year-end in Japan, you have 0% interest rate in Japan. Money is being repatriated. So there's a seasonality strength aspect to the yen. Be careful this month in shorting the yen. That does not mean I'm not a big friend of seasonalities. It's just one piece of the puzzle. It does not mean that I am not trading the yen. I won't. I will short the yen if I have reasons to short it. At the moment, I simply don't. And then you see the pound just reacting to headline news. It's pretty much insane. Dollar. We only have retail sales on Monday. That's expected. These are the newest numbers. I get them off of Reuters. So your economic calendars that you guys have access to probably will show a positive 0.2 or a positive 0.1, depending on which calendar you use. Well, this is Monday morning, fresh, minus 0.1% expected versus the minus 1.2, which were horrible for the December number. And then the control group is expected to come at positive plus 0.6, positive 60 basis points versus negative 1.7. And then you can see ex-autos also coming in a little bit better than last time. Last time was so bad that please expect significant revisions to the prior data point. Yeah, and then potentially a little bit of dollar reaction to the numbers, potentially. Also be aware that the time difference between UK and US, because my friends over there already changed the clock, is now 4 hours. So the US to Frankfurt is 5 hours. You got to be careful in the next couple of weeks, otherwise you'll miss the New York Open or the New York Cut by an entire hour. Okay, and then on Tuesday we have inflation numbers. We have the consumer price index. That's expected to come in at plus 20 basis points versus flat last time. And then on a year-on-year basis, 1.6 unchanged. Gasoline prices finally rebounded about 3% in February, which is higher than the seasonal norm. So we do look at seasonality there when it comes to calculations for our economic models. Retail sales, here you see the dismal number last time, and you see that US inflation started to pick up again, and that is what I talked about early on, also in terms of the average hourly earnings. So you have an economy that is weakening in terms of its GDP growth, versus inflation pressure slightly picking up with oil rising and our average hourly earnings, for example. Pretty difficult scenario, yeah, pretty difficult scenarios. It's actually It's a short in consumer staples. Whoa, another $1 million bit of information that I gave away for free. Japan and the Bank of Japan, yen and the Bank of Japan, excuse me. Friday monetary policy statement and rate is expected to remain unchanged at -10 bips. And the 10-year yield, recall that they have the yield curve control. They're controlling the 10-year, whereas the rest of the Western world, all central banks control the short end of the curve. Japan also controls the 10-year bit of the 10-year bucket of the curve at flat, but allowing this 0% to deviate ±20 basis points. If you really want to look at the market's expectation about inflation in Japan, you need to take a look at the 30-year yields. Another bit of very valuable information. Asset purchase guidelines are expected to remain unchanged. January exports production data came in pretty weak, unfortunately. Production weak and export weak. Maybe that has something to do with the global growth coming up, and maybe that has something to do with this stupid-ass trade war by Trump and China. Watch for recession to creep in. It's not here yet, but just keep it in the back of your radar. What is the recession definition? It is 2 quarters of contracting, i.e. negative economic growth in a row. That is a recession. Capital expenditure data was strong, so that's why, for example, Goldman is pushing out their recession expectations in Japan. Which economy do you know that is confirmed in a recession? Well, it is Italy. And also, if you want to look at a very nice, and this is sarcastically meant, bear market, look at Greek equities. Remember the Euro crisis. All of the same shit is happening again. Greece equities tanking, bear market, Italy in a recession, TLTRO, meaning the ECB is rescuing banks in Europe again. It's the same playbook. They're doing the exact same thing that they did last time. The euro is going to tank and tank and tank and tank. Equities in Europe are going to drop. If you're long European stocks, please hedge or get the hell out. It's not a place to be long, okay? If for some technical bounce reason Morgan Stanley is right and the euro were to rise this week, I don't give a shit. I don't care. It is so weak, I don't buy it. It's not my cup of tea. For me, I want all ducks in a row. I want to have economic tendencies in line with technical, in line with sentiment, in line with positioning, and then I can trade accordingly with what I see. Okay, and then we have the Bank of Japan may lower its production and export assessment. They need to do that based on the numbers, and they need to adjust their models, and that's pretty much the only thing that we're looking at. They recently stated that they are happy to additionally ease, if that's still possible, if momentum towards inflation target weakens due to economic slowdown. And that's exactly what we're having. We're seeing economic slowdown in Japan. GDP, final GDP came in green, so it's slightly better than prior. That's fine, that's good. Nevertheless, we have a overall weakening economy over there, and the Bank of Japan and all its speakers and members are adamant to proclaim that to the market, that we're going to weaken and push out stimulus because our inflation target is not being reached. And their inflation target is 2%. They haven't seen it in forever. So 30 years of printing money without inflation, lost decade after lost decade. That's precisely where we're heading in Europe, because in Europe we have zero. Let me be very, very clear about this. Zero. Zulu, Echo, Romeo, Oscar. Zero idea for a bright future. Our idea in Europe for a bright future is socialism. That is bullshit. And that's why I'm so disappointed that we're just about 27 cooks in one kitchen. Can't happen, right? Anyhow, we have final PMI. Look at that. That's manufacturing PMI. That does not look like an economy that is expanding. And then we have CPI dimpling around 0.5 for the core number year on year. That is very far away from 2%. Very far away from 2%. All right. Pound, last but not least, Wednesday we have the quite important annual budget release with its macro projections. It's not a full report this time due to the Brexit debacle, but nevertheless, we are very eager to see what projections the Bank of England is communicating to the market. So what's important in there? and we are thanking HSBC for their outlook. GDP expected to be lowered for this year to 1.2 from 1.6, and that is what I was trying to state early on, that the Brexit uncertainty, the politicians being unable to handle that in a more professional manner, causes the economy to suffer. And we're seeing this now in the annual budget release, where it's expected, similar to the ECB, where they also lowered their GDP and inflation expectations. A similar scenario is expected for the UK. Of course, it's part of Europe, right? So why would there be something significantly different? Because it is that scenario. UK, largest trading partner, is Europe. And for 20 and 21, both cut to 1.4% growth from 1.5. In terms of CPI, i.e. inflation outlook, that's also been lowered. So again, an economy where you see GDP growth coming off, dropping, and inflation coming off, dropping, that is an economy where you want to buy the sovereign bonds. Yeah, you want to buy sovereign debt, treasuries. So 2021 also, well, they're maintaining 2 and 2.1% in terms of inflation. Why can they maintain a higher inflation expectation than Europe? Well, because they're not part of the euro. So the pound getting hammered is actually means they're an island, they're importing. That actually means the weak currency will import inflation. Okay. Makes no sense for me to educate that much. I keep catching myself doing that. I just can't help myself. Anywho, HSBC looked for last October's 18-19. That's public spending. The forecast to be lowered to 23.5 from 25.5. I think that gift in the amount of 1.6 billion to suffering areas, rural areas in UK that May, for political reasons, spoke about is not in that number. May was trying to get the Labour Party to vote for her deal by promising 1.6 billion in additional help for rural areas in the UK, which, if you recall, were the main voters for Brexit because they felt left behind, similar to why Trump was voted into office. Anywho, 1920 raised to 33.5 and 2021 lifted to 28.5. So what we see here is that the Bank of England expects public spending to increase after the Brexit scenario. That's good because they're going to step in with additional debt. Doesn't mean I have to like it or not. Basically means economic growth means debt is growing. If companies and people are not raising their indebtedness, then the government will step in and do it for us, so to speak. And then, last but not least, we have in terms of gilt issuance, i.e. how much does the Treasury need to issue to refinance all of this crap above. They're looking for supply for 2019 to 2020 of 119.8, 18 to 90, 97.5, and 5 billion pickup in the stock of Treasury bills. That's very short-term financing. So what we can see here is a chart of the 10-year yield, and the yield is already coming off from the swing high towards 1%. Okay, we saw that, for example, on Friday. In Germany, the 10-year yield was above 30 basis points, and then we had this rally. Treasuries were rallying, the Bund was rallying, i.e. meaning in terms of cash price was being bought because no economic growth, inflation expectations being lowered by the ECB means long Bund, basically means the 10-year yield went to 0.06. I fully expect the 10-year bucket to go negative. And then in Switzerland, the 10-year rate was at, on Friday, minus 0.36 or minus 0.38%. I can't recall off the top of my head. So the fixed income market is very, very well aware that there's no growth, because very roughly stated, the 10-year yield of an economy should roughly, this is super rough, right? Should roughly be the GDP growth rate. And you don't see this at all, right? So, naturally, I expect the Treasury market to the 10-year yield in the UK to go towards 1%. What's this? No, that's wrong. Sorry, I didn't take this out. This is an old slide. Let me just see if I can kill it real quick. That shouldn't be in there. I apologize. GDP was the last. Okay, good. And a possible trade opportunity for this week. I'm staying away from pound. I don't believe in the euro long at the moment. The dollar is strong. I expect it to recover. Again, currently looking at a euro dollar short, but I haven't gotten the signal yet. I was looking at Aussie and New Zealand, and I found something interesting that I would like to share with you guys. Short Aussie, it's not Aussie dollar, it's Aussie New Zealand, you muppet. One sec, just got to change it again. It was a great weekend, but obviously I'm not quite awake yet. I apologize for that. All right, so Aussie, New Zealand. Aussie, rate cuts getting priced in. We talked about this on our first slide this morning. Towards the end of the year, we have several large banks. I think Westpac were the first ones to come out with it, but others are joining towards the end of the year, 2 rate cuts. Boom. We have company profits that came in worse than expected. We have GDP and retail sales coming in worse than expected. So that's a Australia is basically a suburb of China. China is slowing, is coming off. We had Chinese equities tanking on Friday. Monday morning, slight recovery because the People's Bank of China and the Finance Ministry stated we're going to support, but Asia is in the bin. Yeah, it's dropping. Global growth is dropping. So Aussie can't be long at the moment. No way. Kiwi, on the other hand, milk makes up a large part of their economy, but commodities in and of itself, it's a commodity currency, it's a carry currency, although it's not being used for curry at the moment. Anyhow, GDT and commodity prices coming in better than expected. So there's a rising trend there. Then we saw a strength in retail sales this morning or overnight. We saw a very positive print in electronic retail card spending, and the construction came in better. Construction numbers also. Construction and retail sales are actually input variables for the GDP number, which the RBNZ forecast at 0.8, at 80 basis points of growth. But currently, the input variables put into the model suggest that it's growing above the 0.8, i.e. at 1%. That's why we saw on Friday and yesterday the strength in the New Zealand dollar, because a lot of guys of the big boys kind were positioned short, and they're realizing, whoa. The economy is doing better than we were actually pricing in, and I would like to join them on the long side. Seeing there's a D missing, so let's put that D in there. So my trade is short Aussie versus New Zealand. The risk to the trade is that the economic numbers are coming in much different than expected. Don't really foresee that, but it is a risk, and or China miracle to support the Aussie dollar. The conclusion of the trade war is not a miracle anymore. You will see this in the US stock market. If there's no conclusion to the trade war, if there's no agreement, Trump is under political pressure to get that shit done. 95% of that trade war resolution is priced into US equities. You will see them tank. Tango, Alpha, November, Kilo. That shit's going to tank if the trade resolution is not printing soon. And I don't think it's going to print very soon. The Chinese understand that he's under pressure, and they played him well. So the trade short Aussie dollar, I'm looking to trade short from 1.0368 area. I'm looking to make around 118 pips, and my stop loss is 59 pips above. That pretty much puts me at a risk reward ratio of 2. Perfect. What else can you want? Nothing. If, by the way, I get stopped out, then something has changed in the market, downtrend is dead, and I misread something, or i.e. we have different fundamental drivers that were not on my radar. So let's check the time. Don't see the time, doesn't matter. Let's check the questions. Alex, Aussie dollar. Yeah, I saw that. Vincenzo, I'm with you, my friend. Are you from Italy? Looks like you're from gold. Oh, Svayunas, long, okay? Long. Gold is a long. We have real yields in the US coming off, meaning dropping, and we have a risk of sentiment in the market. That is a long. Last week, we saw 4 days of accumulation of the by the big boys in gold. and then the catalyst to hit the $1,300 per ounce futures target in the front month was the non-farm payroll numbers. So any retracement of gold is a go, definitely a long. What else do we have? Italy, the only land. TLTRO, very good, Bodo. Tell me about, do you use to the point of control and fair value? Christine, very good question. Just Google MT4 volume profile, and if you don't find that, you can use a market profile, and in the indicator settings, because they use up a lot of resources, just ask them to maybe look back for 3 days and limit the amount of charts that you put it on while looking at the platform, because it's a very weak platform. DAX EMO short top edges. Yeah, okay. Ulrich, one of my former traders, good to see you, by the way, Ulrich. He's talking about the Hong Kong peg. The Hong Kong dollar is pegged to the US dollar. So obviously it's a very much smaller economy than the US economy, which is the largest economy in the world, you know, even though China is gaining fast. The Hong Kong Financial Market Authority intervened last night, or in the last few nights, in the Hong Kong dollar because speculators are attacking the peg of the Hong Kong dollars and and I fully expect the speculators to win that game. Because it's a city-state, they do not have the same resources than the Federal Reserve of the United States have, but they're importing their monetary policy from the US. So Hong Kong, the city-state, is not the same economy than the US. Anytime that you peg your currency to another currency, you're basically giving up the reign over your own monetary policy, right? And I fully expect the Hong Kong dollar to get broken. It's not something we trade. I mean, do whatever the hell you want, but my traders are forbidden from trading pegged currencies. We don't touch them. If you look at euro versus Swiss franc a few years back, it was a Wednesday that the head of the Swiss National Bank, Jordan, hit the mic and said the peg stays in place, everything is cool. And the next morning, he unraveled the peg. It was economically not viable for the small economy, Switzerland, to keep the peg in place. We knew that. I was working at the bank at the time. We knew the peg would unravel 100%. We didn't know when. And it was very, very mean to be stating a few hours prior, the peg is safe, I'll keep it in place, and then the next morning he unraveled it. It cost the large banks hundreds of millions, and a few of the retail brokers went under, and a lot of retail traders lost everything. So let's conclude it at that, guys. Have a very, 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 Aussie dollar. Thank you, Hendrik. We need to change that. My guys are super switched on. Thanks, guys. To my guys, I'll see you guys tonight. To Alex, thank you for the webinar. Thanks for the opportunity to be presenting to you guys. To you traders, I wish you a great week. It's not as volatile as last week, but let's see how they fuck up the Brexit. Excuse my French. Just really, really at my loss of patience. And I wish you all a great week. And I'll see you hopefully next week. And that's it. Alex, thank you very much.
Thank you very much for your comprehensive analysis, Jay. Thanks to the audience for listening. I hope you enjoyed today's webinar. If you did enjoy it and would like to review it, you can do so anytime. Just give us an hour or so to upload it onto YouTube. I wish everyone a good day ahead. Goodbye. Bye, guys.